Welcome to Barenaked Money, the podcast where we strip down the complex world of finance to its bare essentials. With your hosts, Josh Sheluk and Colin White, portfolio managers with Barenaked Capital Management Inc.
Welcome to the next episode of Barenaked Money. I'm joined by Matt Kempton today, portfolio manager with the team, and it's a very exciting day on the markets. We'll get to that shortly, recording this April 3rd. But Matt, a couple of weeks ago, you reminded me that it was a very special 5-year anniversary. What was that 5-year anniversary a couple of weeks ago?
Yeah, the anniversary of what was also ultimately a very special day in the markets, and that was the market bottom of the pandemic period, March 23rd, 2020. 5 years ago now, which it feels like a lifetime ago in some ways, and in other ways it actually feels like, the memories are still there. And a day like today where we're seeing a lot of red on the screen, those feelings come right back.
Yeah, it's a period of time, an entire year that I blocked out of my memory entirely. So you'll really have to carry this podcast, more so for personal reasons than for market-related reasons. But I digress. So it was March 23rd, you said, I think, right? That was the absolute bottom in the markets at that time?
That's right. That day, March 23rd, which, that day, of course, where alarms went off, the green light came on and said, everyone, this is the day that everything has changed. But I didn't feel that way on that day. And I don't know if you did. And March 24th, despite the market going up some that day, nothing said this is the end of the market going down. You can start. It's okay now. We're going to start moving higher, and moving higher pretty rapidly as well.
Yeah. At the time, and still to this day, the most rapid bear market and recovery from a bear market in all of history. So it happened really in the blink of an eye when you look at it going backwards. And it's funny you say March 23rd and March 24th wasn't that day where you had the alarm bells going off. Well, neither was March 25th, and neither was March 26th, and neither was April 26th. There was no real indication that, hey, we've bottomed. This is it. Markets are going higher from here, especially because we were all still locked down at home. Economies were sort of in panic mode at that time. We didn't know it at the time, but sure enough, that March 23rd day would have been an amazing day to throw a bunch of money in the market and wake up today or 5 years later with a handsome return.
Absolutely. I mean, March 23rd, we didn't have a vaccine. We did not have any of these things that we are now.
We didn't even have work from home. We were working from home, but we didn't have work from home. We didn't have video. We didn't have ways to communicate with people. We didn't have Zoom. We didn't have Teams. We didn't have any of that stuff.
And if you did, you're still trying to unmute yourself to get into a call. Like, this was
Exactly.
not a time where you thought this is all done with. I mean, the word depression was being thrown around, and not just emotionally how people were feeling, but economic depression, like all together. It was a very challenging period. And, I think it's important to reflect on it though, because it's such a reminder that we can't time the market, and we don't necessarily understand when things are going to turn, how quickly they're going to turn, and why this occurred. And we as investors are doing our best to every day take a look and understand the landscape, and so are all professional investors. And when you look back to that period, I mean, those that have been through so many of these cycles and have in some ways made a lot of their fortune through them, many of them, looking back, didn't handle this as you thought they might through a textbook performance of others. I mean, I remember Bill Ackman calling for, let's just close the market down. Billionaire hedge fund investors, let's just close it down for a week. We just don't know what's going on. Close this thing, and then we'll come back to it when things calm down. Never heard of something like that before, but that's where people's mindset was at for that period.
Yeah, pretty well. And I think it's important to just put a pin on exactly what this means in terms of market returns. I looked up the MSCI World, so sort of global stocks, just before the call here. And as of yesterday's close, from that low point on March 23rd up until yesterday, the global stock market was up about 150%, very close to that. So that's again, just over 5 years. So pretty remarkable return that you would have missed out on if you had some type of emotional response and sold and sat on the sidelines potentially over this period of time.
Well, that's exactly right. Or even, again, if you tried to follow the professionals. I mean, Warren Buffett has made his money in many cases through these periods. You think about 2008, the Buy America article where, listen, it's time to get into the market, and he didn't get the market bottom quite right, but he was buying when others weren't. He wasn't he wasn't investing any money through that spring period. You have Stanley Druckenmiller, maybe one of the greatest traders of all time. I'll distinctly remember the interview in April where he said, "This is the worst setup for equities he's seen in his entire career." And there was good reason for him to say something like that, but he was wrong. Looking back now, we can say, he was wrong with that statement. And so, when those with some of the best track records of all time are, saying this is not a time to buy, but they can be wrong too. I guess is a big point here is, hey, even the best can be wrong as well.
Yeah, very difficult. So, again, we're sitting here today. We had Liberation Day, as some will want to call it, yesterday, and I think there's a lot of parallels that we can draw from this past experience. But still sticking with that 5-year ago period, when we look back now, do you think that there's like a smoking gun, like we should have realized that this was the bottom, or it was this type of event or this type of activity that led it to be the bottom? Do you think we can tell that in hindsight today?
I think the one thing you could maybe point to is you had real support from central banks to get through a period like this, so that they would do their best to create liquidity, that they would do everything they could in terms of managing interest rates, and that people really grabbed on to that as a bit of a sign, some faith to say, okay, this might get us through. In the end, I don't think that's enough to truly drive a market higher as it did, but that might be the one shift that started to occur around there that just gave people, frankly, some hope, I would think. And despite the economy still effectively being closed and unemployment numbers skyrocketing and all of this that was happening, central banks in some ways said, we have your back. And that might have been enough to get investors back in.
It's interesting because it might just have been that the market was down 30%. Like that might have been the reason that it was the bottom. Because when you think about like what the market being down 30% is telling you, is that all of these global companies in aggregate, when you add them all up, the value of all of them is 30% lower on March 23rd than it was, say, 2 months earlier. 30% is a lot. It takes a lot for companies' profitabilities and revenues to be impacted to that extent. So that's when we talk about buying opportunities. At some point, things just become cheap enough and overdone enough that they're attractive again, and people pull their heads back above water or out of the sand or wherever their heads are sitting at the time, and decide that, yeah, it's okay, we'll get back on this train. And so hard to know exactly what that day is.
Well, exactly. And to that, what was also interesting is 30% or so is about the average experience that a market will draw down through a recession. And it went almost to that average experience. And I don't know if that was somehow investors knowing that and saying, we're there, or if it just happened to be, this is a case of you had about an average experience, but that's about that level. So it was interesting as well to see, ultimately that being where, as far as we went, but having no idea at the time.
Let's transition this to today, because we're sitting here, the market's down, whatever it is, down a few percent at this exact moment. And there's a lot of emotional selling, maybe we can call it, as of today, based off of yesterday's evening's tariff news, where there's basically tariffs on every country that's exporting goods into the US at this point. So give me 3 lessons from 2020 that we can apply to today, where there's sort of similar parallels.
Maybe it's one big lesson that ultimately subs into 3, or the first lesson at least is uncertainty is always present. And at some points it feels more present than others. I mean, very much today, there's no question that everyone feels unsure of what does this mean? What's going to happen next? When we're done our call, if I refresh my browser, what's the new headline that has just come out? Like that's very much where we're at. But that's where we were at for different reasons 5 years ago as well. I mean, what was going on then? This was an experiment really for the global economy, maybe as this is, I suppose. Like there are, the 100 years prior, there were tariffs that were put onto this level. Well, 100 years prior to the pandemic, we were looking at the Spanish flu and say, well, that's kind of what we can draw some conclusions to. The economy looks very different today than it did 100 years ago, though. So there isn't really, maybe there, you wouldn't say there's precedent for this, and you didn't for the pandemic either, but we got through it, and markets move quicker than, they don't need to see the resolution of the event to move. They always will move sooner. They're always looking ahead. I mean, markets started to pull back before in 2025 years ago, before things, before we all were sent home. The bear market had almost begun, and it started its way back up into a bull market well before anything had been resolved. My wedding was still being rescheduled through that period. We weren't able to gather. We weren't able to do, any of these things. But the market had said, we're going somewhere up. We're going to have a resolution to this, and market recognizing that. And to this, I mean, at some point, maybe that's today, but we're in a period of uncertainty, but that we'll never be out of that period fully. And we feel it a lot today. And that's part of why you're seeing such drastic moves in many stocks here today and the overall markets. But uncertainty is always present. And if you're waiting for that to go away to get into the market, well, you'll be on the sidelines forever. Like that's
you'll be waiting a really long time.
Yeah. Exactly.
Yeah. And people say this to me, our clients say this to me all the time. Like, it feels like a very uncertain time right now. And I try to reinforce, like, it's always uncertain. If it's not tariffs today, it's going to be something else tomorrow. Like, and just think of what we've gone through the past 5 years. We went through the pandemic, then we hit this period of very high inflation, coupled with multiple wars popping off around the world. And now we have tariffs here today. There's just always going to be an event or an issue or a concern or a worry at any given point in time. And you're absolutely right. You can't be waiting for that worry to be gone before you make an investment decision.
So I think that's the main takeaway. I mean, do you have others that are related or separate from that you take from it?
I think that everything's going to be related to that idea, but the big thing for me is you don't want to panic during periods of time like this, because as we often say, emotion destroys wealth. That type of panic and that fear-induced investment decision, almost certainly going to be a bad one. I don't think I've ever seen somebody make an investment decision in fear that's worked out in their best interest. Even if
Josh, but they'll tell you, but 3 years later, they'll tell you, I sold that out remember how I told you to sell at the right time and I bought back.
Yeah.
And don't go look at the statements though. Don't go look at the trade confirmations.
No.
But
well, my next point was going to be, even if you manage to sell at exactly the right time, the chances of you getting back in at the right time are going to be very, very, very unlikely. Can you imagine if you sold in like January 1st, 2020, and then everyone's at home from the pandemic, like everything's been shut down, all the sports leagues, the offices are all shut down, nobody's on the road. You're going to tell me at March 23rd comes around and you're going to be like, you know what? I was totally right in January. I'm going to be buying in back into the market right now. Like, nobody's going to do that.
No. And you know what? This just sort of hitting me. So let me talk through this and maybe it will make sense or maybe it won't. But if to that sell that you might do, and maybe you get it somewhat right, that you say it's time to go to cash. But what's driving that? It's probably fear's driving that a bit, or the anticipation of fear. It's like maybe it's one or maybe it's a little bit of both. But to buy well, you have to take the complete opposite action, which is to buy when that feeling has come, the feeling you thought was going to come, and it has basically peaked. It is crescendoed, and you're going to say, now I sold because I felt fear. Now I'm going to buy because I feel fear.
Yeah.
And I just don't think that's just not congruent. I don't think someone can do both of those things. You might be good at one side of it, whether that's there's so much fear I can buy, or there's so little fear I should sell. But to be one who can do both, I'm not sure that anyone holds both of those sides within them. It's just too hard.
Yeah, very difficult.
Is that something? Did I come up with something there?
Well, no, I think that makes sense, because you have to kind of buy at the maximum pessimism, right? As we say,
Right.
but as you can say the cliche any way you want, buy when there's blood in the streets, whatever it is.
Right.
So I think there's some truth to that for sure. And the thing is, even if you get it right once, like let's say you go through one cycle and you get it right once, the chances of you getting that right repeatedly or consistently, very, very low, like almost as close to zero as you can get. And it only takes one miss to really blow up the investment strategy in sort of a catastrophic way. So
Exactly.
something to be very careful with. We're talking about market timing, basically, especially around emotional periods like this. I think maybe the biggest takeaway, if I could tell, and no, this has never helped anybody, but if I could say one thing to people is like, don't panic. That's not going to help you really. Those words are probably not going to make you not panic, but it really needs to be sort of level-headed investment decision making at the moment. I think also it's worth mentioning and worth reminding people, as you said, uncertainty is ever present. There's always going to be periods of time like this that just, pop up out of the blue. Even though this one was, we're going to look back and people are going to say, well, this was very telegraphed, but to know that this was the day that all these tariffs were put in place when we've been talking about it for 6 months, it seems. I don't know that that's exactly true, but it does reinforce or remind us that if you have short-term needs for cash, for money, for whatever it is, that's best suited for a cash-like investment, like a savings account type of thing. That's not something that you want in the markets because COVID happens and all of a sudden your portfolio is down 30%. It takes a while to recover. So it does reinforce and remind us that that's something to not be complacent about, I guess.
Yeah, I would absolutely agree with that. That we know periods like March 2020 can happen. They have happened, and they potentially will happen again. And the sell off of this period here, it's been fast. It doesn't look like, it hasn't yet at least looked like that period, and we don't know that it will. But if you have short term needs, you don't want to be subject to, well, what's the right day in this month to get that money out for the car I'm looking to buy or the trip I'm looking to take. That plan should have already been in place and liquidity available to make sure that that money is stable, because the time horizon here for what this period looks like, we don't know, and the market risk shouldn't be taken for money that has a need in a very short term. So absolutely, that was a big lesson. I always knew that, I suppose, but March 2020 really made that more clear to me, and I think to clients. Oh yeah, if I have something coming up, let's make sure we have a cash plan for that, whether that's 1 or maybe 2 years. There's a safety net there that should exist just for the unknown.
Yeah, for sure. And I think that how big the safety net is depends on, one, your risk tolerance, but also how flexible your sort of spending needs are. Yeah. So if you have more rigid spending needs where there's not a lot of flexibility, you can't really change them even 18 months out, then you probably want to have a little bit more cash on hand. If the goal 18 months out is to buy a new boat and you're comfortable deferring that for a year, then maybe you shrug if the market's down and say, yeah, I'll do that next year when the market's back up. So there can be some art to that idea of how much do you set aside as well.
But Josh, how much a boat's going to cost next year with all these new tariffs?
That's a really good question. Too soon, Matt. Too soon.
Fair enough.
Yeah.
Yeah.
I think another thing that and we're kind of seeing it today, but something that we saw in the pandemic period was that there can be some very material dislocations. So even in the market as a whole, recovered relatively quickly that time around, but there were still some areas of the market that were left totally out of whack, and even here today are still out of whack. And you can look at some real estate, for example, like office real estate, some of the retail spaces, more bricks and mortar retail, that's pretty out of whack. At the time, it was energy prices that were totally askew, like negative prices for barrels of oil, which was totally bizarre. Now that fixed itself, so to speak, a lot more quickly than some of the office and real estate issues have. But that's another thing where these very sort of global shock events, if we want to call them that, there can be some pretty severe dislocations in some more specific spots of the market.
Yeah, that's a great point. And so this doesn't mean whatever this is right now, there may be lasting impacts to some sectors, countries, or we just don't know. It won't necessarily all spring back to this is how the economy will go back to. So we do have to be mindful of that there may be changes that come from it, and
Yep.
have to be aware of that. But I think it also speaks to the importance of diversification
Yep.
into a period, well, just as a default, because we don't know. I mean, like you say, energy, if you were a very Canadian focused investor in 2020, you felt it quite a bit more than many global peers because of your energy allocation you'd have within your portfolio. It would have been, it would just be significant to follow what's here in Canada. And there was a period where, like you say, oil prices went negative, and that part of your portfolio was really, really damaged with, not sure where it was going. Didn't think it made any sense, but didn't know what the resolution looked like. So diversification, I mean, having different pieces in the portfolio, your experience doesn't have to be like the headline reads when you open up Bloomberg or you open up any other news source. Diversification can and really does soften that, as much as maybe it's overused. It truly is not the free lunch you get in investing, but it is the one. It's one of the only benefits you can find that can take some risk away when we just don't know, which is always.
You said Canada's up today. I see it down a couple percent. Am I missing something there? Are you looking at a different Canada than me?
I'm seeing us up. If I got a live quote, I'm up. I'm seeing us up. My browser hadn't refreshed. We might.
Oh no.
Yeah, we are down. We are down.
You were very optimistic on Canada for a second there, but no, I think the diversification part of it, I think, kind of brings these lessons full circle, right? The first thing you said is uncertainties ever present, and I think diversification kind of ties a bow in that. Is like, how do you deal with that uncertainty that's ever present, and periods of time like this, and periods of time like COVID, and periods of time like literally every other time, is by having proper diversification. Because if you were all in oil, for example, leading into COVID, you got ruined. Like there's no recovering from negative oil for you, I don't think. And if you were all in office real estate, well, you're probably really, really challenged if you had a little bit of leverage on that office real estate. But by diversifying, you might have exposure to some of this stuff, but you have exposure to the things that are working as well, like the work from home type stuff. And today's kind of the opposite. Like we're seeing some of the more interest rate sensitive parts of the market, like real estate, do reasonably well today. And bonds, like you said, do reasonably well today. So that's where the diversification kind of saves you. There's always diversification by definition. You're always going to have something that's not doing as well as other parts of your portfolio, but you're always going to have something that's doing better than everything else in your portfolio as well. And that's extremely important because, as we say time and time again, it's often not hitting the home run that's going to build and preserve your wealth. It's just avoiding blowing it up and making consistently smart decisions. It might not always be the optimal decision, but it's always a reasonable decision anyway.
Exactly. And when you think about our role in managing wealth, I think that's the one key way to do it, is avoiding the blow-ups, and diversification allows us to do that.
So we sit here today again, April 3rd. Where do we go from here? What do you think's next?
I think we're all going to be glued to the news for the next little while, and watching some whipsawing of headlines, which will translate into the market. I think we're going to have it'll feel like a little more of a resolution in this spring. I think we'll get to a place of, okay, we weren't where it might not look like it did 6 months prior, but it will look like a place where businesses at least can make a decision, whatever that decision is, and say it might feel like they have a little more clarity in terms of policy, in terms of path forward. And that doesn't necessarily mean things are great for be it economy or the market, but it might just be a little bit more of a every day, and within intraday, things aren't changing so much. I don't think we can do 4 years of this much back and forth, but I might be wrong. What do you think?
Yeah, this all seems a bit contrived. In some ways, it's very different than the pandemic era. Obviously, in a lot of ways, it's very different than that. It's interesting because when Colin and I recorded a podcast a couple of weeks ago, he was saying a pandemic type of event is easier to deal with because everyone bands together for sort of a common force, which there's some truth to that. But I just think that type of period is so damaging economically that it's really hard to deal with. Whereas today, it seems like we may have the tools more readily at hand, like i.e. just making different decisions that can pull us out of this period of time relatively quickly. So I guess kind of the same thing that you're saying is we may have a resolution sooner than we think with this, or not.
Yeah.
We're kind of prepared for everything, but it's another one that's tough. It's just tough to predict, and this is another reason why would not be a proponent of like selling to cash or something like that, because all of a sudden someone changes their mind 2 weeks from now, removes a bunch of tariffs, and away we go. And it's hard to know. It's hard to know for sure that that's not going to happen. And you could say, well, I'll just wait for that to happen. Too late. Too late. If you're waiting for stuff, as you said before, to be less uncertain or more certain, it's going to be too late. The market's already going to have rallied in your stead. So it's going to be an interesting one. I can tell you for sure, I will not be glued to my TV or my newsfeed. I'm just not going to pay that much attention to it because there's not a whole lot of decisions to make from an investment perspective. And I'm really not that interested in whatever gets applied at what time to what country and what industry.
Yeah, fair enough. And that's an interesting point Colin made, but I think I'd take this period over that period because we both had economic uncertainty, but at least through this one, I'm not worried about going to the grocery store and they don't have any toilet paper. I'm not worried about walking down the sidewalk and having to move out into the road because I saw someone else coming near me, or any of the other strange things that were happening.
But where do we import our toilet paper from? I don't know where we import our toilet paper from. That could be a huge issue.
No, we've got some that's made right here in Atlantic, Canada. So we're close to a supplier of that. So
all right.
Toilet paper wise, I think we're okay. Other than that, I'm back to the boats and others. I don't quite know.
It's good. This is a really good question you had added to our outline here. If you could go back and tell yourself something 5 years ago, what would you tell yourself?
I think it would just have to be, it's going to be okay. Like it was a truly hard period. Like, it was unlike anything I've ever experienced. And because of just the economic uncertainty, maybe the career uncertainty, the emotional uncertainty, I mean, the health uncertainty, and just combine all of that together, and you're trapped in your home and you can't even, have an outlet with your friends like you otherwise would have. And, you're joining them on a Zoom party, and it's just the most absurd period that this will end. And through it, I tried to have that faith. I mean, I'm sure you had people in your life who would say, no one will ever travel again. This is the way it is now. And I never took that. Maybe just too much of a dumb optimist to ever take a stance like that. Maybe it made sense to think that way at that time, but I just felt, no, that's not how people are. People need to get back to socializing, to doing the things they enjoy. And I don't know when we'll get there, but I'm quite sure we will. In the depths, it was you didn't know that, and so the money, the economic part mattered, but all the other parts were probably more important and more just present right in your face, that you couldn't leave the house, and it was tough. So probably just, it's going to be okay. What about you?
I'd probably tell myself this period of time is going to suck. Just to mentally prepare myself because I think I went in, it was whatever, April, let's say, of COVID. And again, I'm like you, probably on the optimistic side of things and thinking, okay, by June, this will be good.
Yeah. And
then June came and I was like, okay, well, but July, it's going to be good. And then it was, okay, well, by October, this has got to be good. Right. And I think my wife and I had a flight planned to Hawaii in October or November that year. And when COVID hit, I was like, okay, well, at least we're 6 months away from that. It's not going to be a problem. So I think I would need some mental preparation to know how shitty things are going to be over the next couple of years, but followed up closely with, but it's all going to be okay. And then the other thing that I would tell myself is, I don't know, I can't remember now which countries or areas of the world really kind of thrived through COVID, but I'd probably tell myself, go move there for a couple of years, come back in a couple of years, and you'll be happier for it.
Yeah. I mean, you're right though. That cycle of just it's going to be better at this time, and especially because we were planning a wedding, so we kept having to push it and say, well,
Yeah,
this
that's
is
brutal. I can't imagine that.
It'll be good by then. And then we've got to, rules have changed. And then, but you might remember there were these flare-ups too. And so it was okay. And then all of a sudden it was, oh no, we're in this other, what were they, phases, whatever they called them, that just kept coming. That was tough. The other thing I would tell myself with the benefit of hindsight is buy. Get in there, put some money to work. It's you don't realize it, but it's a good buying opportunity.
Yeah. And I think the market's not really down that much yet. Like it's nowhere close to 30% drawdown or down, 5 to 10%, depending on the market that you're looking at so far this year. So it's not that pound the table buy type of opportunity. But I think the other sentiments that we're saying here, like, it's going to be okay. Things might be rocky for a little while. They might get worse from here. We don't know. But they're going to be okay. And at some point, there's going to be a time where we look back and say, well, that was an incredibly attractive time to invest. And we just don't know exactly when that's going to be.
Yeah, I hope we'll do I hope we won't do a 5-year anniversary call of this date, because it won't be significant enough to even think about it won't even resonate that, that was 5 years ago.
Yeah.
Because this really will just be a bit of a blip.
Well, didn't you hear Liberation Day is actually going to be made a holiday going forward? So we might have to celebrate it every year.
Well, there we go. There's something good that came of this, I guess. Right? Yeah, close the market. There we go. Close the market.
Yeah. Again, I think we just leave everybody with the idea is that as dark as things can look at times, we'll look back and say that was, maybe not nearly as bad or catastrophic or damaging as we should have thought from a financial perspective. The global economy and companies around the world are incredibly good at finding ways around challenges and issues and continuing to be profitable and make money. And ultimately, that's what's gonna drive economies and stock markets forward. And that's why I have optimism today.
I couldn't say it any better. So maybe with that, we sign off.
We didn't like the way investment management firms worked in Canada, so we built Barenaked, something different. You can find us at annoyingthecompetition.com.
For more information on the subject of today's podcast or any other financial topic, please visit us online at verecan.com. That's verecan.com. There's plenty of information there, or you can reach out to someone on the team. Thanks for listening.
Please note, the information provided in this podcast is for general information purposes only. It is not intended as financial, investment, legal, tax, accounting, or other professional advice. Our discussions are not a solicitation to buy or sell any securities or to make any specific investments. Any decisions, based on information contained in this podcast, are the sole responsibility of the listener. We strongly advise consulting with a professional financial advisor before making any financial decisions. Listeners should be aware that investing involves risks and that past performance is not indicative of future results. Barenaked Money is produced by Verecan Capital Management, Inc., a licensed portfolio management company in Canada. We operate under the regulatory framework established by the provincial securities commissions in the provinces within which we operate. The views expressed in the podcast are our own and do not necessarily reflect the official policy or position of any regulatory authority. Remember, at Verecan Capital Management, Inc., we focus on aligning our goals with yours, prioritizing integrity and transparency. For more information about us and our services, please visit our website. Thank you for listening, and let's continue to challenge the norms of the financial services industry together.